I think we are in a new bull market. I think there's a lot to be excited about, and 2035 sounds about right. That would be a 10-year bull run from here. Fed independence is really important because the Fed is the single most powerful entity in the world, right? Because what the Fed says triggers an instant response across all markets and CEOs and policymakers everywhere and even government. So that being independent is critical. I think the most important thing I'd emphasize is that when you're investing, you should really think of it more as you're buying companies, not just buying the stock market, because then you'll have a lot more conviction about what you own.
Tom, it is great to see you, especially here in person, and welcome to the Master Investor Podcast.
Yeah, I'm glad to be here. I'm excited for your series.
Well, it's really a treat to have you. And I mentioned there Fundstrat, which you founded a decade or so ago. I imagine you've got all sorts of clients, but one of your aims for doing it and leaving JP Morgan was to try and broaden the type of people you reach.
That's right. We wanted to democratize access to institutional quality research, but really make it understandable, because I do think historically institutional research was full of jargon and really difficult to understand, and I don't think it was that friendly for a dentist or my father to pick up. So when we started Fundstrat, we thought it was important to make sure we use plain language, make it really straightforward, and then not confuse people with like 3 or 4 different views, but just sort of stick to a thesis or a theme and let investors then decide if they want to act on it.
And we're going to put in the show notes, by the way, how people can subscribe. And you're also super active on X. The handle's @Fundstrat, and well worth following. So you've basically, if we really step back, been bullish since 2011. And as I've said repeatedly on the dips, told people to buy even at periods of great market stress. And we've been chatting on CNBC through the years where I've thought, gosh, how's he doing it again? And you've ultimately proven to be right on all of that. What, stepping back, do you think you have seen over the course of the last 10 to 12 years? Or what have you put more weight to than your rivals that has allowed you to get so much of that correct?
I think it's a couple things, Wilfred. I'd say I think when it starts with our evidence-based work, we put a lot of weight into understanding demographics and then the role history plays, like in each context. But I think it is one of the really misappreciated things that demographics really explains almost every bull market since 1890, actually. So if you followed every generation, the gaps between the generations are really where the bear markets exist, and the bull market tops coincide with the peak of a generation. So 99 was the peak of the boomers. 74 was the peak of, I think it was called the generation before the silent generation. Gen X peaked in 2018, and millennials will peak in 2035. So those are like rough waypoints for when actual major tops take place. I think the second thing that we found is investors, as they age, become wealthier, but then they become more skeptical. And so most of the wealth in America is held by older people, including institutional managers, right? They're over age 40. But the world in disruption is caused by young people. So I think investors tend to think their own wisdom drives the economy, and it's actually, they need to put on the lens of a 20-year-old. That's what we do at Fundstrat. We survey constantly, so we think about what young people are doing, and they drive ultimately the markets and economy. And the third thing is, I think we don't lack recency bias. Like we turned bullish at JP Morgan on February 2009, and we identified upcoming low that would look like 29 or 74.
Which was the following month, right?
Yeah, it happened. Yeah, so we were a month early. So we suffered a drawdown.
We'll allow you that 1 month error.
Yeah. But what was interesting is that people were skeptical because that generation of investors just went through the dot-com bust and now the GFC, so they were now equity skeptical. So they couldn't imagine anyone would want to own equities for the next decade. But that bias is the reason why stocks can positively surprise. And so and even most recently, I think there's a bias now of people having a pessimism about inflation and pandemics, because we did suffer through 5 years of that. But that's causing people to now be skeptical of the world because that's in their bias. And so I think we're judgment free that way. People call us perma bulls, but it's really more we're judgment free.
So in terms of where we are right now, I mean, you said 2035 there on the demographics. Are we very early in a new bull market? But we've obviously had a extended bull market already.
Yeah, I think that's what confuses folks, because I would say generally we've been up since 2020, but we've had two 20% declines since. So in fact, this has been a really disrupted recovery since the 2020 lows. And so I think we are in a new bull market because we just had another essentially wipeout that happened February to April this year. I do think that the bigger story arc is that there is a big surge in U.S. prime age workforce. That's the millennials and Gen Z. Plus, they're inheriting a lot of wealth over the next 20 years, which is going to be transformed into more equity exposure, less credit. And the third is that the U.S. is at the center of a lot of the major structural changes taking place, AI and now blockchain. But those are going to really boost financial sector, which could re-rate to like 40% of the S&P. And then, of course, healthcare could benefit. So I think there's a lot to be excited about. And 2035 sounds about right. That would be a 10-year bull run from here.
That's really interesting on those sector picks, which I want to get into in a second. But sticking on the broad market for a moment, in terms of the risks that are out there, and we've had Jeremy Grantham on, we've had Ray Dalio on, so we've touched on some of these. But are you not concerned about, let's talk of the main one of the week, Fed interference, for example? Or if anything, does that spur equities potentially?
Yeah, I mean, Wilfred, Fed independence is really important because the Fed is the single most powerful entity in the world, right? Because what the Fed says triggers an instant response across all markets and CEOs and policymakers everywhere and even government. So that being independent is critical. I think that we're going to ultimately find that the administration does see to what markets rationalization is, and I think the markets don't want to see a non-independent Fed. So I'm going to lean towards the idea that Fed Chair Powell serves his term. But even if it's just noise now, it is just someone comes across as more not happy with policy, but they're not going to interfere.
So similar, I guess, that the markets forced the hand after the tariffs a little bit. What about the headline debt to GDP aspects that we talk about a lot?
Yeah, that's a problem. I mean, if you don't put governors in how spending takes place, then governments keep expanding the pie, and we don't want to crowd out private sector spending. So I think there is a lot of negative implications for a budget deficit, and then, of course, the debt burden that comes with it. But there are a couple things I would just highlight as offsets. One is that the U.S. has a really big balance sheet that's basically valued at zero. If you compare the U.S., they own a lot of assets that other countries have already privatized, whether it's the postal system or in the U.S.'s case, even how they're valuing their gold holdings, national parks, land, resource rights. I think I've seen informal calculations. This does come into the tens of trillions of dollars. So the U.S. is a lot less indebted than it looks. And the second, of course, is if the dollar's dominance is set to grow in the next 20 years, then this is not a problem. So it really comes down to whether dollars are being more accepted over time.
Well, that's something for us to discuss, particularly as we get onto the crypto stuff. But just to put those two last questions together, is there a level of longer end rates that maybe more of a trading call as a short-term call that makes you bearish on the stock market?
Yes. So we look at the general relationship between yields and PE or risk premium. You can use any metric, and it's not a linear or even exponential relationship. It's actually dynamic. So below 2%, when yields are below, and this is pretty true with most countries, PE tends to actually decline the lower the yields go because it's more of a deflationary environment. But between 2 and 6%, higher yields are associated with rising PE. because I think that, and I've seen academic work, generally somewhat higher elevated nominal growth and even nominal inflation, 3%, is good for corporate earnings because companies can out-earn that cost of capital. So PEs tend to rise. So between 2 and 6%, you'll actually have rising realized PE. So as yields get to 6, I actually think PEs would go up. But then after 6%, of course, you start to really crowd out private sector's ability to out-earn the cost of money, so the PE should fall. So I think, yeah, I'd say between 5 and 6%, you have to start derating the stock market.
And I guess the chances of that, you'd almost expect the Fed, regardless of who's in charge, to kind of step in to prevent that for other reasons.
That's
or
right.
Not.
Yeah. I mean, the Fed, on the one hand, will be yielding a lot of money on their balance sheet from 6% rates. I mean, if the long end is 6%, but it's obviously a huge debt burden to the economy. So I think the Fed would use balance sheet expansion to probably manage rates if they had to.
Pick this up. You said this on, I think, the Compound and Friends podcast last week. Whenever the VIX has been above 60 and closes below 30, 100% of the time, that's been the bottom.
Yes.
That's what you said, right?
Yeah.
And that's true 100% of the time?
Yeah, we never found an instance that it didn't work.
So my question is there a reverse of that? Do you have a statistic that would point to the top like that or something you look out for?
It's a great question. Like, this is where I think our work kind of helps, is that a lot of people say, like, oh, this measurement never seems to work at all. But what we do is we slice it into ribbons. And we say, well, at the extremes, is one side or the other signal? So that VIX is a great example, that at the extreme reading and then flipping back is actually really good signal. It doesn't work the other way, meaning like if the VIX is suppressed and then it rises, it doesn't signal. I mean, short term it could signal de-risking, but it doesn't signal a major top.
What do you watch out for then? I mean, if the demographics and the current thesis is 2035, what would be a flashing warning sign?
Well, if we're looking for a major top, the top is going to have two sources of the negative catalyst. The first is a policy shock. So at the top, the Fed could pull the rug. That's sorry, not the right term. The Fed could end liquidity, and that would create a pullback. I mean, even a bear market. I mean, like if we saw it in 2022, the Fed had to basically put a heart attack on the economy, and the stock market fell. So if the Fed decided that the economy was overheated, there is no bull market beyond that point. But we would both mutually see the warning signs because the Fed isn't operating in the dark and they're seeing the same data. The similar shock would come from a commodity, like if oil spiked to 300. Well, the level has to be, it's a burden on households. So I think it's like now, well, maybe with inflation, it's probably $400 oil. You have to get really high oil. But the second source of a negative catalyst is excess speculation. And that was 99. Because in 99, so much money was available. People were demanding that you get on board with a view. So
you don't sense that at the moment?
No, there's not, because there's so many skeptics. And on our clients, when we have 400 hedge fund clients, meeting after meeting, and this is interesting, someone inevitably always says, Tom, everything you're saying is fine, but I don't believe you because you're always just bullish. And so they're immediately skeptical of everything we just said. We could lay out everything for 30 minutes and they'll say, but you're always just bullish, and they don't believe me. So there's skepticism at these levels. That's not a top. Margin debt's something we can measure. It really needs to have a meaningful leap above the prior high to signal a top, and we're not there yet either.
Just want to remind our listeners, all things crypto we're going to discuss separately. It'll drop in a day or so with Tom. Tom, to wrap up the main conversation, as flagged beforehand, we always end the same three questions on this podcast. The first being, what's the best investment you've ever made? Or perhaps for you, it's the best investment call. Maybe you've already touched on it. Was it 2009?
The best investment call I ever made. It's It's hard to say. The best investment I ever made is my family, of course. But
Always welcome that answer.
yeah.
Hear, hear.
But in terms of the best investment I think that we've made is, I'll say based on the feedback we get, is really people saying that we kept them in the game. So like when I run into people and they're saying, Tom, and they're not subscribers, there may be someone who follows on Twitter, they're like, Tom, you kept me from selling everything in April, or you kept me from selling everything in 2020. And I think that that is something they're grateful for. Because as you know, once you sell something because it's a painful decline, you're so reluctant to get back in. So just keeping people invested has been big, because a lot of people said, now we've heard people say that their retirement plans have been moved 5 years forward, or they've been able to retire because the market has really helped them save money.
And I've walked around, I mean, admittedly Wall Street and New York City, but with you, and you really do get stopped everywhere. It's people listening in the UK wouldn't quite believe that. He's like a superstar on the streets. What about the worst call?
Oh, well, yeah. I would say my worst call was 2022, because Mark Newton, who I was just getting to know, had actually told me, Tom, I think we're going to be down at least 10%, or no, 10% or more. And I think at that time I said, okay, well, we'll be down 10% in the first half. But it turns out Mark had detected, because markets tend to detect problems in the economy. Mark basically flagged that there was going to be this structural problem, which was the inflation that was going to rip through the market. And so it was really, he was saying 10, but maybe it was biased to the downside. And I think if I really appreciated his message, we would have played 2022 differently.
Well, again, we're going to put both Tom and Mark's Twitter handles in the show notes, as well as a link to subscribe in full to Fundstrat. To wrap up this first main episode, Tom, we asked this of everyone. What is your overriding piece of investment advice for our listeners?
I think the most important thing I'd emphasize is that when you're investing, you should really think of it more as you're buying companies, not just buying the stock market, because then you'll have a lot more conviction about what you own. I think when people really understand Tesla or Palantir, and then they don't worry about tariffs and inflation, because they know that these are really smart companies. So I think if the more they believe it as a series of companies they own, the more likely they're going to hold on to their stocks.
I've never heard that before, and I love it. Tom, for this first part of the conversation, thank you so much. It's been a pleasure. Great to catch up, particularly in person. And as we've mentioned, coming in the next day or so, we'll be dropping the next part of my conversation with Tom on all things crypto. Remember, nothing you've heard on the Master Investor podcast should be considered direct financial advice. There's more in the show notes on that. The Master Investor podcast is produced by Paradine Productions.
Well, good morning, friends.